Give them a bit of time to get on.
Can you hear me? Hello.
Yes, now you are.
Yeah, can you hear me now?
Yep.
Yeah. All good. All good.
You're on mute.
Yeah. Hello. How are we, everyone?
Well,
Oh, yeah. That's good to know. I'm guessing AJ is having some technical issues, so he will join later. Yeah. So yeah.
Hey, Kartik, you're very difficult to hear.
Yeah.
I'm not sure if you need to take off your headpiece or your headphones, but just concerned for the.
Okay. Okay. I'll just try changing it. Hello. Yeah. So can you hear me now? Am I audible?
Yeah, we can. It's all good today.
Not the
Just
best.
a little bit better, but still really hard to hear.
Oh, okay. I'm not sure what's happening with that.
welcome everyone. It seems that Andrew's having some issues, some technical issues. So I'll kick this off for the moment, and then hopefully Andrew will be able to come in and give us his thoughts as well. So we always look forward to the budget, and then we always get depressed after we've heard the budget. It's just one of those things that happens every single year. There have been some massive changes this year. The government is trying to do something to bring housing down and to change our tax system, hopefully for the better. It will change the way we think and the way we invest and the way we make our decisions in the type of structure we need. And hopefully through this webinar, we'll be able to give you a bit of idea of the changes that we may need to do. But I always say, always arrange a meeting with one of the accountants, and we will be able to particular needs on an individual basis, because this is just general advice, and it may not be suitable for everyone, because we each have different structures and we're in different times of our lives. So at this stage, I will say to the person taking, just hang on a sec, who's first? So I'll pass this over to Kartik, who will start the seminar.
Hey guys, can you all hear me now?
Thanks.
Yes, we can.
Oh, fantastic. Sorry about that. A few technical issues. Is everybody able to see the brochure?
Yep.
Yes.
Excellent. All right. Just give me a second and I'm going to chuck on our PowerPoint. Thanks for taking over, Peds.
No problem.
You know me. Apparently the most technical person here, and every time this seems to happen.
Problem is we have the worst IT manager that you can have.
Yeah. So look, everybody, firstly, thanks very much for coming on today. You are able to ask questions as we go. The concept of today is really just to try and bring everybody up to speed with what potentially, is going to go on with this budget. I wasn't privy to what Pedro just said, but, there's a lot of massive changes. There's been a lot of stuff in the media, and I think there's a lot of ambiguity, a lot of anxiety, whether some of these things are going to come through. So we've split this up into the different parts of the team. We're going to be looking after different sections. By all means, feel free to jump in and ask any specific question that you want. We've got 75 minutes, and hopefully we'll answer all your questions, but this can also lead into people just booking in a check-in about your particular issues. We're happy to provide as part of our ongoing service. We're happy to talk to everybody for half an hour. If you want to sit down and do some actual tax planning, obviously, we're happy to do that too, but we'll quote for that. But we just hope you enjoy it, and I suppose this is our thing today. So this is just big picture. So Kartik's going to talk about personal stuff. Kartik's a qualified accountant, been with us for a while now. So is Pei Xing. Kevin's just coming on board and taking over as a partner. He's got a very long history and lots of experience. Obviously, we all know Pedro, and Ty's just sitting this one out today, but he will be available for people to ask questions. So that's just a quick snapshot, and I will send everybody this afterwards. But apart from that, Kartik, off you go.
Thanks, AJ. Thank you there. So yes, not a lot of changes for the personal tax income, just as everyone knew, like during the budget. So it's just like, one good news is like the second marginal tax rate is like going down from the current 16% to. Hello.
Could you just talk up a little bit at all?
I am like, I think like I'm having my earpods are having some difficulties, like, so yeah.
Oh, okay.
Yeah. So yeah, basically it's the second marginal tax tire, which is going down from 16% currently towards 15% next financial year, and then like another percentage down to like 14% in like FY 2028. So which is a good news. So we are looking somewhere around like $268 tax savings for next financial year, and then 536 the following financial year. And on top of that, like there is this $1,000 receipt-free standard deduction, which kicks in on 1st of July 2026. So which is a good news for anyone who's like not good with saving, like keeping their receipts. So that's one bonus. And then there is also like $250 WATO, which is Working Australian Tax Offset, which kicks in FY 2028. So good news over there. Like not very like not a great savings next financial year, but like the following financial year, yes, we are looking at like some good amount of returns.
So Paddy, you might want to notice to my sake, because people saying they cannot hear you.
Okay.
So just for my reference, just say the market.
So to your response.
So what was that, sorry?
So sorry guys, like I'm just using previous hello.
Yeah. So, I mean, the take home for this really is that, you know, the rate's going up from 18 to 45. So, you know, that's just trying to clear the decks for people who don't earn that much to try and have less tax to pay. I think the $1,000 receipt over in the UK, they don't even make you do tax returns up to a certain point because they think the time and effort in trying to trawl through your income, if it's at a particular level, is just not worth their hassle. So I think this sort of $1,000 receipt thing coming through, they've just assessed it, and the cost of policing, you know, all the receipts that people had versus, you know, bumping it up so people don't have to worry about it, is probably a really good thing. And like Kartik said, particularly for people who aren't that good at hanging on to receipts.
Yeah, that's true. So yeah, I'm sorry, like I've just changed the place like where I'm talking from. So yeah, sorry to Peter and like Heather, like if they're not able to hear like earlier. So yeah, what I was saying is that there is this like 1% reduction in the tax rate from 16% currently to 15% next financial year.
We still can't hear you.
We can't really hear you, mate. I don't know what's going on.
Again?
We can't hear you.
Okay.
Yeah.
Not
Well,
sure.
anyway, if that's all the personal stuff. So if anybody's got a question about personal stuff,
Yeah.
I'm sure that'd be good to reach out.
Yeah, I can want to add in something, AJ.
Yeah.
So the $1,000 is the receipt free. We don't need to substantiate the expense. It's for the D5. We communicate with the NTAA and they say that currently on top of $1,000, we can claim on top of that a donation, taxation fee or personal super contribution on top of $1,000. So $1,000 look like under D5 work-related expense.
Right.
Yeah.
Okay, so it's not just $1,000. There's still your other expenses on top of that, but that's just
right.
without
D5.
receipt.
Yeah.
Okay. The other thing that I thought I'd bring up is if anybody's got any kids who are still on HEX, I don't think it was specifically addressed in the budget, but the interest rate's gone through the roof because they're putting it up to I think it's in step with the CPI. So a take-home fact for that is if you have kids that have got HEX debts, if they can try and pay them off, or if you want to try and help them pay it off a bit sooner, it's probably a good thing because the interest rate, I don't know, one of you guys would probably know better than I, but I think it's up around the 10 or 11% or something. I'm not quite sure. But I just know that people are getting hit hard. So, and I don't know if you can do it now, but you used to be able to do some deals with the ATO. And if you paid a lump sum or something, they gave you a bit of a discount. I think Albanese gave everybody a bit of a free kick on some of it, but definitely worth having a think about. If you got if they got some money lying around in a savings account, it might be better off just trying to reduce that HEX debt.
Good point, AJ.
Yeah. Okie dokie. Let's move on. Just next one. CGT, Pei Xing.
Yeah, just
Calling the weapon at work.
AJ, can you help me out?
Are you there?
Can you hear me?
Yeah, I think we are having technical difficulties here at Shuriken Hornsby.
Oh, are you been logged in twice or something?
No, so it's myself and Beijing, like we both are having issues.
Yeah, we never had this
Well, I
issue
can hear
before.
you now, so
Yep, I can hear Kathy now.
Okay.
Yeah.
So Beijing, do you want to jump in here and
Okay, that's all right.
yeah, just hold on, Beijing's just
yeah, that's fine. I mean, these CGT changes are pretty significant. I mean, I personally don't know. And by the way, if anybody wants to jump in, I think you have the ability to throw in. Oh, no, sorry, to hit the unmute button. So yeah, CGT is it's a massive change. I don't really know how it's going to affect the housing market going forward because we've got a lot of clients who've got rental properties, and particularly in Sydney, and they're just getting hammered on the land tax. And because they're getting hammered so bad on land tax, the rents aren't even covering it in a couple of the cases, and these people have paid their mortgages off on their rental properties. So I mean, if you're not going to be able to claim some of these CGT concessions, I don't know what's going to happen to the property market. I don't know. Pedro, you got any thoughts on that, or Kevin?
Well, according to to what I've read, it basically says that the whole aim is to reduce the price of housing so it becomes more affordable for the next generation. A lot of the economists say it's not going to get affordable; it's just going to grow at a much lower rate than it has in the past.
Yeah. Okay, cool. Well, we'll just keep going. Pei Xing, if we can hear you, great. If we can't, then
Yeah, let's try it. Can you hear me now?
Yeah, that's it. Just speak loud and slow.
Okay. Yeah, I'll try it. So yeah, just as Pedro just mentioned, government are trying to cut the price, especially for the affordable housing. Actually, for the new amendments, actually the reform of the CGT, they have exemption for the affordable housing. So if you are the property you are disposing, sorry, can you speak up? This thing really does not work, right?
Right, go on. So the property, what you're saying is CGT for new properties is going to stick around because they're trying to encourage people to continue to put money into new properties. Is that what you're saying?
The exemption it particularly apply to the affordable housing. So if you are disposed or transfer an affordable housing, you can still use the old, the one we know as usual, the 50% discount, the general discount. But if you are not, say you have other investment like shares, especially you're having them under your own name or you are trading them via trust. If you have shares or other investment to dispose, you will no longer be having that 50% general discount after July next year.
Right. So I suppose the take home from that is that the bill is still before the Parliament at the moment, so it hasn't gone through. And I would say that particularly if anybody's holding investments, shares, property within your trust, family trust, or if you've got a property trust, and also individuals, we probably really should sit down and have a good talk about how this potentially might affect what's going on next year. I mean, my worry would be too, just generally, I mean, I read something today, the housing market's taking a bit of a tank in Sydney. If people get a little bit gun shy and want to start flogging off assets and interest rates, start to go up, then who knows what's going to happen by the time July 27th. So I'd say probably the take-home point when it comes to CGT is if you got investments in your individual or in the trust, we probably need to sit down and have a chat and have a look at how it's going to impact you personally. A lot of our clients, have stuff in trust because it's trying to create generational wealth where they can transfer the stuff on down the track. What's interesting to note is that companies are impacted. Well, to be honest, companies don't pay CGT anyway. Companies are just, assessed on what their company tax rate is. But what's interesting is super funds. So, I raised a question the other day with our external guy that we use for financial planning, that if you start to buy property in the super fund, are you still going to be able to claim some of those discounts? And could that be an area where some clients start to move? Now, we're not licensed to tell you should, and I'm not telling any of you should, but it's definitely something you need to probably investigate if you've got a financial planner, because they're the ones who can advise on what sort of asset structures you can buy through your super fund. So if you don't have one, give us a bell and we can put you in touch with one. But if you do have your own financial planner, maybe that's a conversation that you want to go and have with them.
So I think Peter has raised his hand, so I'm to
can't hear you, mate. So if we can't hear you, I just don't want to. Unfortunately, we'll have to sort that out next time. Pedro or Kevin or Ty, have you got any comments in regard to that?
I think it's the one of I noticed for this policy for CGT is the minimum 30% tax rate. So they apply 30% on all capital gain tax accrue after 1st of July 27. So that is significant change. For example, if you have any gain from client have zero income from wages, and the gain like $20,000 before, they pay no tax, right? Less than 20K tax-free income. But from this new rule, in this case, they have to pay $6,000 because they apply the minimum 30% tax rate.
That is a very important point. So folks, in the past, if you let's say you were retiring and you had set up this plan that you just sell assets down over the course of time, then what you used to be able to do is you'd add that profit to your current income, and you'd still get the advantage of the tax-free threshold. So just like Ty said, let's say you made a $30,000 capital gain because you sold down some shares, then generally, and if you didn't have any other income that year, then you'd only be assessed on 30 grand, which was not that much because the first 20 or 18,000 bucks was no tax. So to make it a carte blanche, 30% across the board will have an issue for different people at different stages of their lives, and how that's going to affect them. So if any of that relates to you as well, you probably need to come and talk to us, because that can have huge impacts, particularly if people are in retirement mode or soon to be. Yeah, absolutely. Good point, Ty.
Yeah, and super hasn't changed that much in relation to the tax it's got to pay unless, and I'll go through this a bit later on, unless your super fund, your individual has more than $3 million in there.
Yeah. Okay.
Andrew. Yeah, Kevin here. Can you hear me?
Yes.
Yeah.
Yeah, I was just going to say, worth pointing out that indexing replaces the 50% discount going forward. This used to be in place before the 50% discount came in. So assets held over some time will be able to be discounted based on inflation, inflationary measures. The other point I think that is worth pointing out is that there's been a lot of debate in the press around capital gains tax on business sales, and the commentary does indicate that there will be modifications to what has been proposed. One option that might come on board is an increase in the threshold for the small business capital gains tax concessions. But certainly a lot of the press has indicated that our capital gains tax for business sales is, on an international scale, sort of not competitive. So look, I think we can expect some changes to what came out of budget night for business sales, particularly for small businesses.
Okay, that's a really good point, because we do have a lot of clients that have got businesses and they might be looking to exit. So for those of you who don't know, if you have a business and you've had it for more than 15 years and it's a, you know, it's a private company and all of that, and a bit of a family business, there's some options available to you for some reductions in capital gains tax. There's a one-off amount. To be honest, I think Pedro and Kevin would be more across this than I am, and Ty. But that's a really good point. So if we've got anybody, and I think I know somebody who's sitting on the call now, who potentially would be looking at selling their business and want to take advantage of that 15-year exemption, that's a really good point, Kevin. I mean, yeah, great point. All right. Anything else?
There are a number of exemptions that people can used to be able to utilise, and I agree with Kevin. I've also heard that they are looking at the making changes, so I don't think it'll be as bad as what people what happened on budget night for small business.
Yeah, I think just the take home is, I'm going to keep using that word all day, is that if any of this stuff affects you, then just give us a call and let's go through it. Because, I mean, the biggest issue is about anxiety and ambiguity. And if we can try and smooth that out and, you know, put a bit of a better plan together for you guys, we'd love to help. I do apologise for some of these technical issues. Hopefully we'll iron those out. We haven't done webinars for a while, but we'll start to get back into it and sort it out.
Can I call you back? I'm on in a seminar. I'll have to call you back. Okay. All right. Thanks. Bye.
All right, guys. We're all everybody's unmuted. So if you want to say something, by all means, jump in. If you want to just listen, then you can mute yourself and then come back in and jump on. Okay. Next up, Kevin, rental properties. What's going on there?
Okay. Just making sure you can hear me, Andrew.
Yeah, that's great.
Yep, terrific. Yeah, so basically the big change that's received a lot of publicity is the removal of negative gearing for established rental properties, purchased after budget night. Existing rental properties are grandfathered, so they'll continue to be allowed to have negative gearing. I think one of the big misconceptions here is that, interest paid might not be allowed as a tax deduction. So my understanding is that, look, it is, but it can't be used to the extent that you have a rental property loss that can be offset against salaried income to generate a tax refund. So you're actually allowed to, if you're making a rental property loss due to interest, you're actually allowed to carry forward that loss to offset against either future rental property gains. For instance, in later years when your rental property investment loan might be a lot lower and result in a positive rental property gain, you can offset that gain against prior year losses, and you can also offset those carried forward losses from your rental property to reduce your capital gain when your investment property is sold. So look, there still are absolutely benefits in place for rental properties purchased after budget night. So before budget night, nothing changes for your existing rental properties to allay any concerns there. But certainly, after that night or budget night, rental properties can still be purchased. Interest can still be applied as a tax deduction. It's just that it can only be applied to the extent that a rental property is effectively a break even. Okay, and if it's a loss, those future losses can actually be applied against future rental property income or capital gains. So look, they're the main takeaways there. We're not expecting any changes.
What's interesting about, if I can jump in, what's interesting about that is, if we all just think about this conceptually, you've got let's say $100,000 salary. You've got an investment property where you're losing 30 grand on it by way of, it might be cash or it might be cash and depreciation. So what happens in the past is then you get to reduce your tax from 100 down to 70. Now, I know some of you know this, but I just, I try and simplify it for those who don't quite understand. So you go 100 grand and that tax on 100,000 off the top of my head, somewhere around about 25 grand.
Mm-hmm.
Whereas the tax on 70,000 is probably, I don't know, somewhere around probably 16 grand or something like that, or 18 grand. So that's how the negative gearing stuff works. Now, what's interesting, if you have any friends, family, or yourselves, the negative gearing for family tax benefit, the negative gearing for child support, the negative gearing for any sort of Centrelink stuff actually doesn't help you, because it was they always add it back on.
Yeah, it's not included.
So if you think this is going to affect any of those payments from the government, it's already doesn't count. What this really is doing is the government's just saying, look, we don't want to give you that tax break now. We'll still acknowledge it, but we'll give it to you in the future. So it's not you're getting started out of it. It just means that you're not going to get it now. You'll get it when you sell the property, or when it starts to turn around and be positively geared down the track. So it's not an entire deal breaker, but what it just means is the time value of money. 10 grand every year for the next 10 years today is worth more than 100,000 in 10 years' time.
Yeah, thanks, Andrew. Just a few exemptions I'd just like to point out as well. So eligible new builds that are exempt from this change. So eligible new builds, which include apartments bought off the plan, and even knocking a house down and rebuilding duplexes, they're exempt. So negative gearing will be able to be applied to those. Importantly as well is that the removal of negative gearing is only applying to property. So other assets like shares will be able to continue to be negatively geared going forward. And the other point is that these changes apply to individuals, partnerships, companies, and most trusts, but they don't apply to most managed investment trusts and super funds, including self-managed super funds. So negative gearing is still allowed in self-managed super funds. And anecdotally, there has been, since budget night, reports of increases in the number of people taking out self-managed super funds. But as Andrew said, that's one for you to consider and seek your own advice with your financial advisor on.
Yeah, good point. All right, shall we move along to our next cover? Kevin, still got the jersey on, mate? Small business.
I'll keep going. Yeah, so small business changes. Good news. The 20,000 instant asset write-off, is becoming permanent now. For businesses with turnover of under $10 million per year. So that's great. We can take an instant asset write-off on things like equipment purchases, office fit-outs, upgrades of technology, and the like. One sort of new change, which will benefit small business, is the 2-year tax carryback. That's back from 1 July 2026 for businesses with a turnover, or it's actually of up to $1 billion, so that will apply to everyone. So basically, if your company reports a loss this year, it can offset profits in the following 2 years and receive a tax refund, if it's part in their franking account balance. So that's good news. It helps certainly with cash flow for small businesses, and there's further measures that are introduced for small business startups as well, to encourage them in the first couple of years of operation. They can actually claim back startups any FBT and withholding tax paid in the prior 2 years if they make a loss. So that's a great benefit to them. There's been quite a bit of press around EVs, electronic vehicles. So I guess the good news is that the FBT exemption will continue to apply through until 1 April 2029 for EVs costing less than $75,000. And basically up to then, you're going to be able to get the benefit, up to the luxury car tax threshold, which was tick over 91,000 for the 2026 year. So basically from 1 April 2029, there's going to be a 25% discount for everyone on their EVs up to that luxury car tax threshold of 91,000. So if your vehicle's below $75,000 in cost, you continue to be exempted up until 1 April 2029. From that date, everyone gets effectively the 25% discount only if your EV costs less than that luxury car tax threshold of 91,000 and change. So existing leases at budget night aren't impacted by this as well. So there's a grandfathering provision in there as well. So I might just pause there. Does that make sense? Are there any questions on the electronic vehicle FBT exemption?
Feel free to jump in, anybody, or I'm on the chat if you want to ask a question.
Okay.
It
All right,
sounds like that, what's the cheapest EV around? Would that be those build your dream cars?
Yeah, BYDs I think started about 35,000.
30 odd, yeah.
Wow, they're going to go through. I mean, I think they already reckon they're the largest EV producer in the world now.
Yeah, they are.
Yeah. That's a bit crazy.
Yeah, so Andrew, appreciate, there's a bit to get through yet. So I'll just briefly go through the other small business changes.
Yeah.
There are quite a lot of changes for the R&D tax incentives, all of them favourable, increasing, the amount of R&D premium that can be claimed. There's also a reduction in the intensity threshold. So you only need to have your R&D claims going forward to be 1.5% rather than 2% of total expenses. And the turnover threshold.
So hang on, sorry, Kevin, just to jump in, sorry, not to cut you off. So R&D, folks, is if you've got a business idea, it's a research and development incentive from the government. So a lot of you have just individuals that won't really, it's not going to affect whatsoever. But if you've got friends, family, kids, or whatever, somebody's coming up with a new app idea, or they're sure they're going to make multi-million dollars out of it. There are some incentives like the research and development, and there's also an EMDG, which is an export markets development grant. So there's, I suppose, yes, it's changing for the R&D, but just so that everybody knows, if you've got, again, friends, family, or others, or kids wanting to set up businesses, there's plenty of sort of benefits around, both state government benefits and federal government benefits and programs. Sorry, mate.
Yeah, sure. And yeah, look, your R&D benefits can include, not just, doing things like the actual development and the costs on development and so forth themselves, but they can also be the salary and wages allocated to those specific initiatives. So look, if you want to see if your benefit or your business might have a new product or service that could qualify for R&D tax incentives, please contact us. The other changes, Andrew, I'll just touch on them. The Australian Trusted Trader Program will be expanded, offering a new business development function and implementing the approved exporter scheme. So there's opportunities there. There's a reduction in more tariffs that are coming in, and also the tax office is going to be allocated a bit more money on fraud prevention, including live monitoring. So look, that was about it on small business changes, but there's a decent amount in there.
Mate, that's fantastic. Thanks for that.
All right, no worries.
All right, Pedro.
It's always the best till last.
Oh, here we go. Yes.
Hello, everyone. I think the trusts have been the biggest loser in this budget. Something that I know that the Labor Party has always disliked has been trusts. So essentially what happens is these changes will commence around the 1st of July 2028. Trusts will be paying a minimum of 30% tax. They will. What will happen is if the money you've transferred is greater than, if the tax you've got to pay is greater than 30%, you'll just pay the difference. If you're paying less than 30%, you'll lose it's a non-refundable credit, so you just lose it. It also impacts the bucket companies. That means that the bucket companies will lose the non-refundable credit, and it's only for discretionary trusts. So all other trusts, unit trusts, testamentary trusts aren't affected. It's solely discretionary trusts. And there will be a transitional year for up to 3 years to restructure your trusts if you want to. So again, that's something that you'll for individuals, let's have a look to see how we can restructure your trusts so that we can maximise or minimise any damage that these new laws have been put in. Any questions?
Well, I was just going to elaborate a bit. So for the people who have trusts, these are significant changes, particularly where they've been set up for asset protection, but also for generational wealth. So it's pretty significant. We probably really need to run a separate thing about restructuring them all.
Yes.
And what we need to do. I mean, look, if it comes in, it comes in. It's been flagged a lot of times in the past, or it hasn't always come through. For anybody else who doesn't have a trust, this is pretty boring stuff for you. But you might have some investments in a one of those Macquarie funds or another managed investment scheme. So it's good to know that if you've got any investments in those things, that you're pretty okay. The discretionary trusts are really based around, well, that don't have to be, but a lot of people use them for buying property in different states, or for just trying to protect the assets that they've got in their own family businesses.
Correct.
But it's definitely something that'll be a massive shake-up, just a massive shake-up for small business. Absolutely.
Small business and family trust, where you've put money aside, or you're trying to protect assets for the future generation, that'll all change. But it's not going to affect the people that already pay more than 30 cents in the dollar across the group. So for them, it doesn't change.
What's really interesting with that is, if anybody's affected by this, usually your company pays 25% tax. And then if your company's doing a distribution to you personally and you're less than 25%, then you usually get the franking credit in terms of
Correct.
cashback. So what this is saying now is we're not going to do that. So then it kind of just makes it, well, what's the point in having a trust? Why don't you just have the family members as the shareholders back in the company? But, that causes other issues as well.
But that gets harder if you've got underage children that you would then end up having to set up a trust anyway, or you've got to be a trustee for the anyone under 18 years of age.
Yeah, that's it.
Yeah, just Kevin here. Just to that, Pedro, the discretionary part of trusts, discretionary trusts, including family trusts. My understanding is that still is maintained. So there still is, that ability, to distribute at the discretion of the trustee to the beneficiary. So as you mentioned, if you've got a tax rate that's greater than 30% already, there's actually not really a material impact there. Am I correct in saying that?
Correct. Yep.
Yeah.
Okay. So there are still benefits. I think that's the important point to make here. That
I think there are. We also have to look at it, and it's not that we should all go out and close down our trust. What we would look at is how do we distribute it so that we try to get we instead of distributing $20,000, for instance, to someone so they don't pay any tax, let's distribute them enough money so they would have to pay 30 cents in the dollar anyway.
Yeah, so that'd be conversations on everybody's individual case. Yeah.
Correct.
Cool. All right. Next.
Now with super, the other area with super, nothing's really changed. Oh, sorry, going back to the trust. Remember, the government is allowing a 3-year transitional period, so to restructure. The one thing that we need to look at and see how the state government deals with this is if you've got a property in the trust, will there be stamp duty on it? So we now need to wait to see what the various state governments do about the restructure of the trust.
That's a really good point. So let's really sit and think about that. When you have a trust, as most of you do, the trustee, what a trust essentially is, it's a split between the beneficial and the legal ownership. So, for example, I've got a car, it's registered in my name. I let Kevin drive it. Kevin has it for 4 years. He's got the beneficial interest, but I've got the legal title. So with these trusts, the legal title of a property is based in the trustee. So when we change, legal titles on real estate, you pay stamp duty. So that's going to be really interesting on how they deal with that. Really interesting. The other thing too is, as some of you may or may not know, you've got land tax on a lot of these discretionary trusts. Some states have zero. Like in New South Wales, you don't even get a limit on the actual land tax. You don't even get a threshold.
Yep.
Queensland, you get up to 300,000. So just having trusts and properties, it's never been simple. It always depends. But that's a really interesting point about stamp duty. Who knows what's going to happen? But
That's
you wouldn't think that they would hit everybody up. But you never know.
Yeah, you never know. Yep.
And in some client, they got a double layer of the trust. Like this trust is beneficiary of the other trust as well. So we are interested to see how the government want to tax at the trustee level. Like they would double tax for 2 level, or what would they do?
Yeah,
I've actually had a client that's been land tax have had to pay twice because of the double layer.
Yeah.
Yeah. Okay.
Okay.
Super. Everybody should be interested in this one.
Yep. Nothing's really changed in relation to it's minimal changes. It's one of the things the government hasn't really, hit too hard. So essentially, what happens is there's a higher contribution, concessional contribution to 32,500. The non-concessional cap has increased to 130,000. Which then allows, the 3-year bring forward has a limit of 390,000. The one big change has been the Division 296 now applies to balances above $3 million. And essentially that means that if you've got a balance greater than 300 million, you'll pay a further 15% tax on that amount above 3 million. And as you know, clients near the 3 million should really review their cash flows, the liquidity, and what contribution strategy they have. Now, the other important thing is that has not been indexed. So there's nothing that the government has said they will index at $3 million. So that, we've got to be careful that in the next 3 or 4 years, those people with 2 may end up may have their super fund increasing to 3 million. So again, it's something we need to look at to make sure that we can minimise any taxes that people have to pay.
Minimise or at least plan for it.
Yep. That's correct.
Yeah. Yeah, that's interesting. So take home on that is non-concessional cap. For those who don't know, you're allowed to throw in 130 grand a year or 390 over the course of a period. So that can go in, and people say, well, why would you do that? Well, there's tax benefits because anything non-concessional, you won't have to pay any tax on later on in your retirement. But those sort of anything to do with tax related to self-managed super, you're more than welcome to ask us. Whether you should put in extra or not, you need to get your financial planner to cover that off. Because again, under that legislation, they've got to be the ones to tell you whether you should put more in or less in. Okay? So again, if you need someone, we got some good people. Otherwise, go have a chat to whoever you've got there. And then maybe you might want to circle back to us and then we all talk about the tax implications. Or if you want us coming along to a meeting with you with your planner and have everybody in the same room, if you're getting up to nearly 3 million, and you've got some concerns, we're happy to do that as well. Is that it for Super Peds?
That's it for Super. Unless if someone's got a question, I'm happy to answer it.
I don't have anybody asking me anything on the chat. I'm assuming I'm still up there. If anybody wants to jump in and ask a question, feel free.
And we're also, look, if someone wants to give us a call, they're not thinking at the moment, because there's a lot of information that we're throwing at you. If you take some time and then, over the next couple of days, you do think of something, then don't hesitate, give us a call.
Yeah. So just, we've cut time. Oh, we haven't. I thought we had a few extra questions. That's okay. We've got plenty of time. You go on.
I think Peter Morrow has raised his hand. So,
Oh,
Peter,
okay. Sorry, mate.
So Peter Morrow, I think like he's raised his hand. So I think he's got a question. So Peter,
Okay.
do you?
Peter, go. Oh. You there, Peter?
Did you want to type your question, Peter?
To unmute. Am I unmuted?
Yeah, you're unmuted, yeah.
Andrew, the question's already been answered.
Oh, okay. Cool.
That was easy, wasn't it? Yeah.
See how great we are. We answer questions even before they've been asked.
Yeah, that's the miracle. That's the miracle.
That is. Ange Chappell, you seem to have lost sound. Are you back? No, can't see you. We're nearly at the end anyway, so hang on. Ange, I've unmuted you. No. Okay. Now, this is just a small little action plan, right? So, maybe there's a few things you want to think about. Come and have a chat to us. I'll be shipping all this out to everybody afterwards, just so you can, if you get any thoughts afterwards. And then I think the next one, yeah, that's it. That's it.
Yeah.
One thing,
Andrew, Kevin here.
Yeah, mate.
Oh, yeah. I was just going to mention just the conversation you're having around super. And look, it's very relevant, to this time of year, because the requirements are for those non-concessional contributions, to be made actually by 30 June. So effectively, I don't know if, Andrew, you want to go back to that slide, but the non-concessional contributions, just so everyone's clear, they're made from your after-tax income. So you've effectively already paid tax on it. Okay, your compulsory super, contributions, they're made from pre-tax and they're taxed at 15% in the super fund. But the non-concessional, they're additional contributions you may wish to make, which, are made into the super fund up to that limit of the 120, or what was the concessional cap was 32,500, but it can be, the non-concessional cap, of 130,000, but it can be, brought forward as well and made higher. That's a fantastic opportunity to build wealth in your super fund, on top of your normal super contributions. And as I said, it needs to be made by 30 June to receive those benefits. But
but you need to talk to your planner. You need to go and talk to your financial planner.
No, 100%. And also, there is some opportunity, Andrew and Pedro, for some government matching at lower income levels on some of those super contributions.
That's a really good point.
Yep.
Yeah, so if you're on a low income or you've got kids, there's an opportunity, as Kevin said, to match it. So I can't even remember what the scheme was, but if you throw an extra $1,000 or $1,500, something like that, and you don't claim a deduction for it, then the government will match it. That's pretty cool. Talking about other things, I mean, I don't really think the budget really covered off NDIS very well. I mean, it's a massive amount of money that we're spending on that program. It's a shame that there just seems to be it's just like the Wild West. I'd say that area is going to have to get some clamping down in the next couple of years, and there'll be probably quite a few audits. I mean, to me, it's a bit akin of what happened with a few years back. There was every person had a registered training organisation where the government was basically paying for people to do courses, and it was going through the tax system, and nobody ever paid it back. There was stories about people turning up to a particular suburb with a boot full of laptops and said, "Oh, just sign up for the course and you get a free laptop."
Yeah.
Where the person didn't actually know that down the track they were supposed to repay the HEX debt. So that all got clamped down. And this NDIS, it just seems like anybody, anytime can set one up and just take advantage of it. So what I'd say is, if you have a family member or a friend or a person with a need, just make sure that they're not getting rorted, because they have a certain pool of money that they're allowed to spend on themselves. And if somebody turns up to do cleaning and they put down 3 hours instead of 1, that's money out of the pocket of that person who's supposed to be getting this help. So I think if we can all be vigilant about stuff like that, so that, it's not getting diverted to the wrong person.
Yep. Good point.
Yeah. Yeah. Okie dokie, folks. Well, I don't have anything else to say, except just reach out to us. You've just spoken to Kevin, and I think everybody knows the rest of the team, or if you don't, we're all across the different practices now. We've changed our model a bit. We're have a new whole compliance team, which is headed by Claire. So any ATO docs or now Infinity or ASIC stuff comes out of them. We've got Anthony, who's looking after the super across the whole group. And now we've got Pedro, Ty, and Kevin, who are the main partners, principals at the different practices, being Sydney, Manly and Hornsby. And we've got our 2 weapons, being Pashing and Kartik, helping out as well. So we've got a great team, and we're just here to help. So anything we can do, just please let us know. Now, if anybody's got questions, jump in, stick your hand up. And if not, then I'll say thanks very much. All good?
Yep.
Thanks, Andrew.
Yep. Thank you. Thanks, Andrew.
Thanks.
All right, guys. Thank you so much.
Thank you.
Thanks, guys.
Thanks.
Yeah, thanks, guys.